Today, we will review two types of investment plans: Registered Retirement Savings Plan, RRSP, and Tax-Free Savings Account, TFSA. Both are offered to all Canadian citizens, permanent residents, refugees, and temporary residents who have significant residential ties in Canada. This includes a home, a spouse, or a common law partner, dependents, personal properties in Canada, and much more. An RRSP is a retirement savings plan that you can establish through a financial institution, a bank, a credit union, a trust, or an insurance company. The Government of Canada will register, and you or your spouse or common law partner will contribute to it. Most RRSP contributions and investment earnings are tax deductible for the year of investment. Any income you earn in the RRSP is usually exempt from tax as long as the funds remain in the RRSP plan. The tax deductible amount that you can contribute to your RRSP plan is communicated each year by the Canada Revenue Agency. The unused amounts from the previous years are carried forward until you are reaching 71 years of age. This is called your contribution room. Any contribution that is over the contribution room is taxable at 1% per month tax rate. When you withdraw amounts from your RRSP, generally you have to pay the taxes at your current tax bracket. For this reason, this is called deferred taxes. You can start contributing to an RRSP at age of 18. When you turn 71, you're required by law to close down your RRSP. At that time, mainly you have four options. Take it out fully in cash, purchase a life annuity, invest a lump sum with a life insurance company and pay a monthly or annual fee to get a guaranteed income for life. Transfer it into a registered retirement income fund, RRIF. The investment with an RRIF grow tax deferred until you withdraw the funds, or a combination of the above. There are four types of RRSPs. Individual RRSP, one person who is the account holder and the contributor. Spousal RRSP provides benefits for a single spouse and also a tax benefit for both spouses. A high earner, a spousal contributor, may contribute to a spousal RRSP in their spouse name, the account holder. The retirement income is divided evenly, so each spouse can benefit from a lower marginal tax rate. A group RRSP, set up by an employer for their employees. It is funded with payroll deductions and administered by an investment manager. A pooled RRSP, an option for small business employees and employers and the self-employed. Couple characteristics. The RRSP contribution is deducted from your gross taxable income for that year, and you will be entitled to a tax refund. By the time you begin to withdraw the funds, you will probably be in a lower tax bracket than during your previous years, so you will pay less taxes. You can borrow money from your RRSP to buy your first home under the home buyer's plan. You can borrow money for your RRSP to pay for your education under the lifelong learning plan. A spousal RRSP can reduce your family taxes. The RRSP dividend income from US is not subject to foreign withholding tax. This does not apply to other countries. Couple things to consider. When you will start to withdraw money from your RRSP, depending on your total revenue and the tax increases over the years, you might end up paying more taxes than in the initial year of deposit. It really depends on your tax bracket at that age. If you are planning to be in a high bracket, you are better to use a TFSA. Here is an RRSP simulation. Let's say in 2020 you have a total revenue of $155K. You will be paying $57,979 in taxes. This is about 37.4% tax. Let's suppose that in 2040 you have the same total revenue including the RRSP withdrawals. Historically, the taxes increased by 3% over 10 years, so you will be paying 6% more taxes in 2040 for a total of 43.4%. This tax will apply to both RRSP initial amount and interest. So if you invest the same amount in TFSA, you will be paying 37.4% tax in 2020 only in the initial amount and no tax on interest. So overall, you have less tax to pay on the initial amount and zero tax to pay on the interest if you are using a TFSA. After 71 years old, if you have an RRIF, by law, you must withdraw an increased minimum percentage of the value each year, going from approximately 5% at 71 years to 20% at 95 years old. This rule applies whether you need the money or not. So you need to ensure that you have enough money left for each age bracket. If you borrow for HBP or LLP, you will have to repay it within a specified time period. A tax-free transfer of your RRSP or RRIF funds to a retirement plan in another country is not permitted. Let's say that you have 20 years until the retirement and you are investing $500 each month in your RRSP. Let's assume that you have an annual rate of return of 5%. After 20 years, you will have about $205K in your RRSP account. The average inflation rate in Canada for the last 20 years was about 1.9%. Supposing that the average inflation rate stays the same, the real value of your money will be the same as $201,000 today. Not so bad, huh? The TFSA is another great way to invest for long term. The contribution to the TFSA is not tax deductible, but the growth of your TFSA investments is sheltered from taxation even when you withdraw the money. For example, investment income and capital gains. The Canada Revenue Agency is deciding the annual TFSA contribution limit. The unused amounts from the previous years are carried forward indefinitely. The excess contributions are taxed at a rate of 1% per month. There are three types of TFSAs that can be offered: a deposit, an annuity contract, an arrangement in trust. You can start contributing to a TFSA at age of 18. This plan is more flexible, there is no age limit, and there are no requirements with regards when to close the TFSA account. An individual that is a non-resident of Canada who has a valid social insurance number and is 18 years old or older, it's also eligible to open a TFSA. However, any contributions made to this account will be subject to a 1% tax for each month of the contribution stays in the account. Depending on the type of investment held in your TFSA, you can generally withdraw any amount from the TFSA at any time. In general, withdrawals from your TFSA during 1 year will only be added back to your TFSA contribution room at the beginning of the following year. Couple characteristics. TFSA withdrawals do not affect your eligibility for federal income benefits and credits, such as old age security and the Canada Child Tax Benefit. When you retire, even if you are in a high tax bracket, you will not pay taxes on the TFSA withdrawals. Couple things to consider. If dividend income from a foreign country is paid to your TFSA, the dividend will be subject to foreign withholding tax. Your contributions are not tax deductible, so you don't receive the immediate tax benefit as in the case of RRSP, and there is no spousal plan. Let's say that you have 20 years until the retirement and you are investing $500 each month in your TFSA. Let's assume that you have a growth annual rate of return of 5%. After 20 years, you will have about $205,000 in your TFSA account. Because the interest is sheltered from taxation, by using the TFSA you are gaining $41,000 versus a regular savings account with the same rate of return.